Hello there and welcome to Project Business Basics, designed to give you the tools to make smarter financial decisions. Whether you're looking to learn something brand new or just want a refresher on some basic economics, there is a place for everyone on our show. I'm Archit Janarkar and I'm your host. Now today we're going to be discussing bonds. So when we talk about bonds, we have to go back and just imagine a business. And let's say this business needs an infusion of capital right now. So what can this business do to raise money? Well, this business has two options. The first is to take on debt, and this can mean selling bonds, which we'll talk about today, or it can also mean borrowing money from a bank or any other commercial lender. And the second way that the business can raise money is by selling equity. So they sell X amount of shares at X price, and in return for the investor giving them money, that investor then gets a share of the company or equity in the company. So these are the two ways then that businesses can raise money. And we've talked a lot about the selling equity aspect. That's stocks. And then today we're going to look at the other side, where a business takes on debt through selling bonds. And essentially what a business is doing here is they're telling somebody, hey look, why don't you give us your money, and at the end of a specified period, we'll give it back to you plus interest. Just like how when you go to buy a home, you might borrow money from the bank, and you get that money from the bank, but you have to pay it back to them, and you have to pay it back with interest. So bonds work the same way as interest on a mortgage or how it works on a home loan, that you pay the principal back as well as interest that ends up serving as payment to the lender for giving the money originally to you. So we're going to talk about three classifications or three types of bonds today, and the three are government bonds, corporate bonds, and junk bonds. So let's start off then with government bonds. Now government bonds, and we're going to use the US government as a reference point for anything dealing with government bonds today. Now the US government, just like a corporation, they need money to operate. The taxes that they get from their citizens are in most cases not enough to cover their budget. So what the US does is they sell debt. And every single government around the world does the same thing, where you as a debt holder might give your money to the US Treasury, and then the US Treasury promises to pay you that money back during a certain specified time with interest. So with buying US government debt, there are several different lengths of bonds you can buy. There's 1 month, 2 months, 3 months, 6 months, then 1 year, 2 years, 3 years, 5 years, 7 years, 10 years, 20 years, and finally 30 years. So there are 12 different lengths of time over which you can lend them money. And for example, with 1 month, you would be giving the US government, say, $1,000, and in return, they'd give you back $1,000 back at the end of the month, and they'd also pay you a little interest. So you could also do 30 years, where you give them $1,000 now, and then 30 years later, you'll get that $1,000 back plus interest. Now, these treasury lengths have different names. You may hear people refer to treasury bonds, and those are referring to treasury periods that are 20 years or 30 years. When you hear the word notes though, that's referring to any term period with the word years in it, except for the 20-year and 30-year treasury period. So that's going to be your 1 year, 2 year, 3 year, 5 year, 7 year, and 10-year periods. Those are all treasury notes. If you buy one of those, you are buying what is called a treasury note. And then finally you have treasury bills. And those are all of your treasury lengths that are less than a year. So 1 month, 2 months, 3 months, and 6 months. Now even though the US government has it broken down into three different categories, bills, notes, and bonds, all of these function in the same way that bonds work. You pay the US government money, and they'll pay it back to you at the end of the term period with interest. And another thing to note is if we look at the interest rates that are given by the US government for various time periods, just looking at the current 30-year interest rate, it's 1.42%. And the 1 month interest rate is 0.1%. And between 30 years descending down to 1 month, you start to see this interest rate that you get decrease. And that should intuitively make sense. Should someone who gives the US government $1,000 now receive more money than someone who gives the US government $1,000 extended over 30 years? So it makes sense then that if you buy a 30-year Treasury bond, that you'll receive more interest than someone who's buying a bond with a maturity that's less than 30 years. Simply because you're lending your money out to the US government over a longer period of time. You're giving them more time to give you back interest. And just hypothetically speaking, to give you an idea of how all of this works, if I bought a 1-month Treasury bill right now for $1,000 with 0.1% interest, then 1 month from now, I'd get $1,000 back plus $1 more in interest that I would have gotten. So my $1,000 after 1 month became $1,001. Now we've talked about federal US government bonds, but there are also other categories of government bonds. There are municipal bonds, which are exactly what they sound like. Municipalities or local cities or even local counties, they might sell bonds in order to finance public works projects or in order to rebuild a road. They might sell a bond and then also offer you a tax advantage for doing so. So it's not just the federal US government that does it, but also local governments and state governments that sell these bonds. Now let's move on to our second type, which are corporate bonds. Now corporate bonds work very similarly to government bonds, but instead of governments that are selling bonds, it's corporations that are doing so. Now if you'll recall, a few episodes ago we had talked about various financial statements, and we had looked at Disney's balance sheet. And in that balance sheet, we saw that they had in total roughly $100 billion of debt. This debt is there from them selling bonds to bondholders, where these bondholders gave Disney money sometime in the past, and now Disney is liable to pay that money back with interest to these bondholders sometime in the future. And these bond periods for corporate bonds extend over a few months to sometimes several decades, so a pretty wide range, just like US government bonds. Now, we also want to talk about the interest rates of corporate bonds. Corporate bonds interest rates work slightly differently than US government bond interest rates. The way you think about corporate bond interest rates is, let's take two companies. We have McDonald's and Macy's. Now, McDonald's is a pretty stable company. It's been affected by the coronavirus pandemic, but I think most people are pretty sure that McDonald's is going to be there whenever this pandemic ends. Macy's, on the other hand, is really struggling. It's dealing with malls being closed, the company itself is financially not doing well, so it's a struggling company. Now, if you were looking to buy some corporate bonds, and you were looking at these two companies, McDonald's and Macy's, of these two companies, which company has the higher risk of defaulting on their debt and you not receiving the money that you gave them originally in principal back? Well, the answer here is Macy's, because Macy's is the company that's struggling. So Macy's is a higher risk company to buy bonds from than McDonald's. Now, how are the interest rates for these two companies priced though? Well, the way to remember it is lower risk, lower interest yield. Higher risk, higher interest yield. And essentially what's happening is you're being compensated for taking on greater risk. If I decide to give $1,000 to Macy's, I'm taking on more risk. But in return for me taking on that higher risk, I'm receiving more money back in interest because I took on that greater risk than if I had just given $1,000 to McDonald's. So we can see just by comparing these two companies that generally the bonds for Macy's are going to have higher interest rates but higher risk than the bonds for McDonald's. Now we're going to jump to something called bond ratings. And these are going to connect to our final category of bonds, junk bonds. Now there are several notable companies that rate bonds, and we're going to be looking at two of them. There's the S&P Bond Ratings, the same company that manages the S&P 500, Standard & Poor's, also has a bond rating system. And they assign these letter grades to various companies and their bonds. But these letters are not the same as a school grading system. So with S&P Bond Ratings, going down the scale, in all capital letters, you have AAA, AA, single A, triple B, double B, single B, triple C, double C, single C, and single D. So meaning AAA is the highest bond rating that's possible, and single D is the lowest bond rating that's possible. So as a company, you're going to want to have your bond rating in the high double and triple A's, because that means that your company then has to pay lower interest amounts because your bonds are rated well, meaning that there's less risk of you defaulting. Now Moody's is another company that does bond ratings. They have a similar system to S&P bond ratings, but there are a few key differences. So going from top to bottom of Moody's bond ratings, their top one is AAA as well, but it's written a little differently. It's one capital A followed by two lowercase a's. Then after that, they have double A as well, but one capital A followed by a lowercase a. Then a single capital A is the next rating. After that comes BAA, so capital B followed by two lowercase a's. After that, capital B followed by one lowercase a. Then the next rating is a single capital B. After that, single C followed by two lowercase a's, and after that, one capital C followed by one lowercase a, and finally you have one uppercase C. So it's a little different than the S&P bond ratings, but the rating systems are both very similar in the way that they assign these ratings to companies. Now junk bonds. What are junk bonds? Junk bonds, if you take the first word junk, it refers to companies that are not that dependable to pay back their bonds. And what did we say about companies that have a high probability of defaulting on their debt? They're higher risk, so they're going to have a higher interest yield. So with junk bonds, these are companies that are very risky to lend money to, and consequently, they're going to have higher interest rates to pay. We're talking around 10%, 15%, high numbers like that. And you know that a company has junk bonds if their ratings, looking at the S&P scale, it's double B or below, or on the Moody's scale, BA or below. So double B, single B, triple C, double C, single C, and single D, and on the Moody's scale, if their bonds are rated BA, B, CAA, CA, and C. All of those categorizations signify junk bonds. Those companies that are not dependable and have to pay high interest rates because there's a good chance of them defaulting on their debt. And if we go back to the top of the scale, so AAA on the S&P scale, all capital A's, and on the Moody's side, AAA, but one capital A followed by two lowercase a's, those are the highest possible bond ratings you can have. And there are two non-financial entities in the US that have these AAA ratings. Those two companies are Microsoft and Johnson & Johnson. So those two companies have an almost guaranteed chance that they'll repay their debt, but consequently, you're going to get lower interest yields if you loan your money to those companies. So let's recap. A company has two ways of getting money if it needs to. One is selling equity or selling stock, where an investor gives money to a company and in return that investor has equity or a share of the company. The other way is for a company to sell debt, where an investor gives money to a company and then the company promises to pay that money back in the future with interest, just like how a home loan works. Now there were three types of bonds that we talked about today. The first were US government bonds. With US government bonds, you give your money to the US Treasury, and there are 12 different bond periods over which you can loan money to them for, all the way from 1 month to 30 years. And the interest rates for those US government bonds increase the longer the term period is. So 1 month is going to have the smallest interest rate, while 30 years is going to have the highest interest rate. Just like government bonds then, there are also municipal bonds, or bonds sold by local governments. Then next you have corporate bonds. With corporate bonds, investors give money to a company, the company receives the money and promises to pay it back later with interest. Interest rates will vary depending on the company's risk. And then finally there are various bond rating systems with AAA at the top, and then depending on the scale, either single D at the bottom or C at the bottom. Now the ones that are junk bonds are rated EE and BA down below. I hope you enjoyed that episode. If you're looking for interesting business reads and insightful business articles, then I urge you to check out the Project Business